Welcome to our CFP exam prep discussion on life insurance types. Today we're diving deep into term life and whole life insurance, a crucial topic that frequently appears on the exam and often trips up test takers. Let's break down term life insurance first. Term life provides pure death benefit protection for a specific period, typically ranging from 1 to 30 years. Think of it as renting insurance protection. When you buy a 20-year term policy with $1 million death benefit, you're essentially securing that protection for exactly 20 years. Nothing more, nothing less. The premiums stay level throughout the term, and if the insured passes away during this period, the beneficiaries receive the death benefit. If the insured outlives the term, the coverage simply ends. Now, whole life insurance operates quite differently. It's designed to provide coverage for your entire life, hence the name whole life. But here's where many test takers get confused. Whole life isn't just about the death benefit. It includes a savings component called cash value, which grows tax-deferred over time. The premiums are significantly higher than term life because you're not just paying for death benefit protection, you're also funding this cash value account. Let me share a common exam scenario that tends to confuse students. A question might present a 35-year-old client who needs $500,000 of coverage and asks which type of policy is most appropriate. The key is to look for context clues. If the client needs coverage only until their children finish college in 20 years, term life is likely the better choice. If the question mentions estate planning needs, or a desire for permanent coverage with tax advantages, whole life might be the answer. A critical concept that often appears on the exam is the relationship between premiums and cash value in whole life policies. In the early years, a larger portion of your premium goes toward insurance costs and expenses, while a smaller amount goes to cash value. As time goes on, this relationship shifts, with more premium dollars flowing into cash value. This is why whole life policies become more valuable the longer you hold them. Here are some common mistakes students make on the exam. They often confuse the concept of level premiums with level costs. While whole life premiums remain level, the actual cost of insurance increases as the insured ages. The level premium works because the excess premium in early years helps offset the higher costs in later years. Another frequent error is misunderstanding policy loans. Remember, when a policyholder takes a loan against their cash value, the death benefit is reduced by the outstanding loan amount if the insured dies before repaying it. The exam loves to test this concept. Understanding convertibility is also crucial for the exam. Many term policies include a conversion privilege, allowing the policyholder to convert to permanent insurance without proving insurability. This feature often appears in questions about clients whose health has deteriorated but still need coverage beyond their term period. The key takeaway for the exam is understanding that term and whole life serve different purposes. Term is pure protection, similar to car insurance. You pay premiums, and if something happens during the term, there's a payout. Whole life combines protection with savings, making it more complex but also more flexible for long-term planning needs. Remember, no life insurance type is inherently better. The right choice always depends on the client's specific situation, goals, and financial capacity.